Hey everybody, Jerome Maldonado, and it's Wednesday, and welcome to our Real Talk on Real Estate. So the Feds increase interest rates in spite of everything that's happening in Ukraine and Russia. And so let's dissect this. Let's take a look at what the voice behind the Feds has to say, and that's Mr. Jerome Powell. And so Jerome Maldonado is going to kind of dissect that for you guys and explain to you guys what the Federal Reserve is thinking methodically, and what the plans and goals are. And so, in spite of Russia and Ukraine and the war on Ukraine via Russia, we were expecting to see that the Feds maybe soften the interest rate hike that they were projecting. Now, today's meeting was obviously went in the exact same frame that they had anticipated prior to the attack of Ukraine by Russia. And so we saw a quarter percent, 1 basis point increase today. And so there was some questions. And for those of you guys who are investors, this stuff's important to know. But don't freak out, don't panic, everybody, because look, some of the questions that was coming from the Wall Street Journal and the New York Times and a lot of the big writers that are trying to find out, they're interviewing Jerome Powell, they sat back and they said, okay, why is the Feds moving in the direction that they're moving without any hesitation? And he goes, look, the economy is strong. In spite of everything that's happening, we have a super strong economy. Aggregate demand is strong, and there's payroll is super strong. Home and business balance sheets are strong, and so everything, labor right now is strong, and the labor pool is actually improving. So that means that people are going to work. And so unemployment is down. And because of this, they feel like the U.S. has a solid economy, which I believe it is too. So he said the chances of seeing an economic downturn in 2022 is pretty slim. We are going to see inflation rise, and that's a big deal for those of you guys who are in construction. That's a big deal for those of you guys who are going out and doing value add properties. But we're also seeing appreciation of assets as well, which is good. But this is going to start softening. So one of the big things that Jerome Powell talked about today is he said, look, we're anticipating that the estimated real GDP growth for 2022 will still be at about 2.8%, which is good. Next year, we're looking at 2.2%, and 2024 getting back to more of a common 2%. And people were responding back going, oh my God, that's not good. Last year, we saw over 5% GDP growth. Well, that's abnormal. Okay, 5% over a 5% annual GDP growth is abnormal. We don't see that. That's very rare. Our typical GDP growth is someplace between 1.75% and 2% annually. And so even with a projected 2.8% GDP growth, that's still substantially higher than the average. And so if you look at pre-pandemic numbers and you compare them to the growth, the potential GDP growth for this year and where we're projected to go, we're still having an incredible year thus far. And we're projected to have one this year, next year, and then stabilize as we move into 2024 is what the projection is. But obviously, nobody knows for sure exactly where the economy is going to be in 1 year from now, right? There's variables that are outside of the control of any of us. And so having that said, we sit back and we go, okay, we can make economic projections based on historical events that have happened in the past and where we are today and where we see things based on how strong we are economically. Now, one of the big questions that has come in through multiple people, one of the young ladies from the Wall Street Journal said, how do you foresee that our U.S. economy is going to be affected by what's happening in the Ukraine right now? And so Mr. Powell, he said, look, we're going to see effects of it. We're going to see a trickle down. Now, does that mean that does that mean that it's going to go haywire and our economy is going to collapse? No, not necessarily, right? But obviously, again, we don't have a crystal ball. But what we do know is that commodities are going to go up, being that the Ukraine is one of the largest exporters of commodities like wheat into Europe. We're going to see a lot of increase. Now, natural gas, the good news is that we produce a lot of our own natural gas here in the United States. We're not dependent on having that stuff imported in from overseas. So our natural gas is, although we'll probably see a slight increase isn't going to be affected as much as the crude oils. I know all of you guys have seen this at the pump. Everybody has seen the increased gas prices. So in spite of that, we sit back, and as spoiled as we are as Americans, we were seeing prices under $3 a gallon for the last couple of years. In fact, we were under $2 a gallon for a short time during the pandemic. And now people are asking for stimulus checks to pay for gas. And so I just kind of sit back and go, are you kidding me? You know, we've never gotten stimulus checks before. Be careful what you ask for and what you wish for. If you don't want to live in a communist country where our government controls us financially, you may want to be a little careful on what you ask for. Because I know on the front side of that, you sit back and say, you know what, Jerome, I would love to get a check from our federal government. And it's just to that, when you're thinking short term, you sit back and go, wow, it's free money. But the more money, it's kind of like this. You guys have a mom and dad that when you guys were growing up, they gave to you maybe. And then, like I remember I used to see my parents, they bought my sister her first car. But along with that, they had control over that first car, and they would take it back from her as a punishment. So my thoughts were, if I bought my own car, they can't say it's our car. I can't drive it because it's my car. They're my parents. They could have told me that anyways. But me as a young brat teenager were thinking, I don't want to get that money. I don't want them to take my car back. I'm going to buy my own car so that they can never control me with my car, right? Well, it's similar to what the government's doing. They sit back and they go, if they give you money, they can control you economically. So be careful what you ask for, because that's what happens in communist countries is they give you just enough to live, but not enough to get ahead. And so for those of you guys that are sitting back just barely making a living now, don't be so selfish and righteous in the fact that you want free handouts, right? We live we live in a country that our streets are paved in golds, and we have the land of opportunity. Don't lose what our forefathers fought for. You know, we have the opportunity to go out there and do extremely, extremely well. So if you're an investor right now and you're sitting back going, okay, how can I depict this market, Jerome? How do I figure this out? Well, let me give you a little indication of what's happened even today. And for investors, you got to exercise this with thought. Okay. Now I'll tell you exactly, I'm going to explain to you guys exactly how we're exercising and underwriting deals right now, and what we started doing just a few months ago to make sure that economically we're using logic to take down acquisitions that may not be finished or stabilized till a year, 2 years from now. Okay. But when you're looking at stuff, and if you look at the stock market today, everything ended in a downward, in a decline. Now, not substantially, but we had great gains this morning. So the NASDAQ was doing good. The Dow was doing good. The Dow kind of died at about an even playing field. The NASDAQ died about an even playing field. But if you look at what's happening right now with the 10-year Treasury, it closed 2.2% higher, because typically when interest rates rise and assets tend to drop, asset holdings, equity holdings, stock market tends to drop, and the bond market starts to increase. So today was a perfect example of that. I think we're going to see that for a short time till we still see some stability in our interest rates and what's happening with the Feds. But our 10-year Treasury closed at 2.2% higher today. So that's a good indication of how most people think as investors, and they migrate their money. Pull them out of stocks, put them into bonds. Bonds are typically more stable for the low risk investor as opposed to equity and stocks. Okay. Now, this also brings opportunity. So as you, what was the hike? So the hike was 0.25%. So one basis point. So 0.25% is what the increase is. We're going to see about 5 increases this year. So don't be surprised if we start seeing slow, steady increases over the course of the year. The Feds have already warned us that we should see close to 5 increases this year. And so, ladies and gentlemen, as we move through this year, expect it. But we're still at a great place. We're still at historically low interest rates. But when we're talking about investing and purchasing real estate and other stuff, here's how it affects you. Now, I remember in 2016, I went to Phoenix, and cap rates were hitting about low 8s, high 7s, percentage-wise. And I sat back and go, goodness gracious, this is crazy. Things are dropping under 8%. Well, for those of you guys who follow interest rates, follow cap rates and real estate, you guys know that large assets are selling for sub 3% cap rates right now, sub 4% to 3%. So we're between 3 and 4% cap rates. Well, here's the way the cap rate market works compared to interest rates. So what a cap rate is it's the amount of money that you profit from your investment if you paid cash for it. So if you go out and you pay $100,000, just simple numbers, okay? So if you pay $100,000 for an asset and you're at a 3% cap rate, you're making $3,000 a year on your money, on your $100,000. Okay. If you take that 100,000, you multiply that times 10, you buy $1 million asset, then you're making $30,000 on your money each year. That's your annual cap rate. Okay. Now, if interest rates go up, and let's say we hit 4.5% on interest rates for commercial loans, okay, which we're moving in that direction. How can you go out and pay a 3% cap, buy something for a 3% cap rate when you're not even making enough to service the debt on the property? And that's the problem. So what we've done is you have to be careful. You have to be methodical when you're thinking about this stuff and you're investing. You got to sit back, and we've known that this is coming. If you guys follow some of the video footage that I have from last year, at this time, we were talking about being where we're moving and migrating right now by the end of 2021, and then the Omicron variants for COVID came out. The pandemic wasn't quite over where we thought it was, and then all of a sudden we had a second wing of things, and we were in the pandemic full and fledged again throughout the entire 2021. So the Fed's kind of softened it and said, okay, let's hold off a little bit. Let's not collapse the market and panic the U.S. people. We're going to soften this. But their whole goal for the last couple of years has been knowing that they have to increase interest rates. They have to. And part of that is because the federal funds rate got bumped today from practically zero, it's not zero, to about 1/4 to 0.5%. Okay, now what that means, for those of you guys who don't know what the federal funds rate is, it's the money, the funds that the banks charge each other to borrow money, okay, which typically they don't charge much. It's a very small amount. Now they're going to be incurring a 1/4 to 0.5%, and they're projected this year to go up to 1.9%, and next year to 1.9%, and then over the next 2 years to 2.8%. Guess who's going to bear that cost, ladies and gentlemen? We are. We're going to bear it. They're not just going to pay that to and lend the money from bank to bank and incur those fees while they're lending money from institution to institution without charging it to somebody else. So we are the graduated professionals that get to pay that. We are the privileged ones that get to pay that back. So where are they going to get that money from? Well, they're going to get that from increased credit card interest. We're going to start seeing it on our credit cards. We're going to see it on fluctuating notes. So any adjustable mortgage rates, you're going to start seeing an increase on all our fixed mortgage rates, home and commercial. We're going to see an increase on that because that's what's going to fund the federal funds rate that's getting bumped right now. We're going to fund it. We're going to be paying for that stuff. Okay. So here's how it's affected based on interest now, and then I'll explain to you how we underwrite deals. But now when you sit back and you're talking about these interest rates and things going up, some people are sitting back going, Jerome, how does this affect inflation? You know, everything that's happening in the Ukraine and everything that Russia's doing throughout pushing this war in the Ukraine, how does this affect inflation? Well, it's going to. We're expected to have a core inflation growth this year of 4.1%, but an overall inflation of approximately 4.3%. So not as much as last year. And we're expecting it to fall next year. I think by the end of this year, what analysts are saying is they say, look, inflation is not going to be as bad as it was in 2021, but it's still going to be bad. We're going to see an overall inflation of close to about 4.3%. Obviously, they're projecting that. Now, things can change, but they're they said that by the end of 2022, we should start seeing that soften. And as we move into 2023, we should see it go down to about 2.3% inflation next year, which is normal. That's the average inflation rate. So if you take a look at real GDP growth, it's usually about 2%, and inflation is usually about 2%. So they kind of override each other, right? In good years, inflation or GDP growth goes up higher than inflation, and so we as Americans get to benefit from that growth. Now, So we are projected this year to see more inflation than we're seeing GDP growth. That's the bad thing. But we've had some really good years prior, and we'll start seeing this stuff stabilize as we move into 2023, 2024. So hence, with that being said, is there going to be the opportunity that certain market sectors compress? Potentially. And so because of that, the way we underwrite deals is, I'll tell you guys a little deal that we're doing down in Tucson. So we underwrite this property. And when we're underwriting this property, one of the big things when it came to the table is we went to the brokers, and we said, okay, look, what's the need for this asset first and foremost? And they said, okay, there is a need for it, Jerome. We massively need an asset class of 2-bedroom units of apartments that are going to go into this one in particular sector. And I said, great. What are they trading for right now? And they're trading for about $400,000 a door. And I said, holy shit, that's a premium, you know? And he goes, you can't build affordable housing. You got to build a Class A apartment to go into this area, because the area that we're building in, it's a more affluent area. And I go, there's no way I'm going to underwrite this at $400,000. What if the market compresses 10%? And so that's my thoughts, right? So what we did is we take $400,000 and we go, okay, we have $400,000 times 0.10. And we take 40,000 off of that. Okay. So that's $360,000 per door. When we take the whole overall, we actually underwrote it at $350,000 a door. And so we go, let's take this down a little bit and pretend like the market gets compressed slightly over 10% this year. And so we underwrote the deal at a 10% compression, market compression, saying, okay, there's an opportunity if the market compresses this year. And so if the market compresses this year, by 10%, we want to make sure that when we finish building this asset, that we still have affluency in it. Or when we go to underwrite it and we go ask for a bank loan, the bank doesn't sit back and go, oh, Jerome, look, you're dreaming. You know, interest rates are rising, cap rates are changing. We don't want to go there. And so with cap rates, they said, figure a 3.5% cap rate. Okay. I said, no way. I'm not going to do that. Let's go a 5% cap rate. They called me back and they said, no, let's underwrite it at 4%. I said, no way, no how. I've already been looking at this since last year. I'm going to underwrite this thing at a 5% cap rate, $350,000 per door. If rents soften by 10% this year, which they can, and they may not. And if they don't, guess who has the upside? We do. So we're in a good place, right? Guess who? If you're the investor and you underwrite it conservatively like this, and the market continues to go up in value, guess who has the upside? You do. And so when we're looking at this, we sit back and go, okay, I'm underwriting this at a 10% compressed rate. Okay. Do the numbers work? So I sit back and I do dollar signs. I figure out, do they work? Then I get my dollar amount on my build cost and I say, let's underwrite this thing at a 5% cap rate, because interest rates are moving in that direction. Does it pencil? And if it pencils, I sit back and go, let's roll with it. And so we're rolling with it. It underwrites. We're okay with the profitability. We're good with the potential possibility in the potential compression, and we can withstand the test of time and the weathering of the storm if the market does compress. So we're moving along with it. So we have a new deal on the table, and as an investor, we're still moving. So people ask, Jerome, when is a good market to invest? Is this a good time to hold on investing? Well, when you do it as a business like we do, we always invest. It's just the way we underwrite deals are slightly different. The way we were underwriting deals a year ago is different than the way we underwrite them today. The way we're going to underwrite deals in a year from now is going to be slightly different than the way we're recommending you underwrite them today. So hence, click and subscribe to our YouTube channel so that you get continued updates on how the pros are underwriting deals, how we're continuing to move and progress through market changes as you are. And that way you're aware and you get notified when we have new contents, new updates as to what's happening in the market. You like the content, give us a thumbs up and let us know it's relevant, and smash that like button. So look, unemployment was a big thing. Unemployment is at 3.5%. Labor is strong right now. Inflation may drop at the second end of this year, but still higher than, but it's still lower than last year. And so the economy is strong, ladies and gentlemen. We are going to see market compressions and things are going to slightly adjust. So don't have no doubts about it. I'm not sitting here telling you guys, sky's the limit, throw all your money out at a project and don't worry about it because we have a strong economy. I'm telling you guys, be wise, be smart, and underwrite deals wisely. It is going to come. It's just not coming tomorrow. The Feds are sitting back going, look, we want economic growth. But when you see what the Feds reduce their balance sheets a little bit, guess what that should tell you should do? You should reduce your balance sheets. If you have unnecessary bad debt that you don't need to carry, get rid of it. Acquire good debt that's going to pay you, okay? But clean your balance sheets up right now. Don't stop from investing. Just clean up your balance sheets. Get rid of all the bad stuff that you don't need and clean up your balance sheets. Once every 2 years, I try to do this once a year, but I'm guilty as charged. I tell my wife, I'll sit back and I'll go, what's this bill? And what's that bill? And what's this for? And what's that for? And she'll say, oh, I need to call them. We need to cancel that. We're not even using this. And I'll see stuff from like QuickBooks that we were using when we had our Subway stores that we're still paying subscription fees of $100 a month. And as stupid as all these little things sound, it ends up adding up to be like a couple $1,000s a month in just trash can money that you're throwing in the trash on goods or services that you're not even utilizing. And so this is the time to start cleaning that stuff up. Wise investly, tighten up your investments, because the oil at the pump and crude oils are going to continue going up for a little bit of time until all this stabilizes. Natural gases, thank God, we're going to get a little relief from that since we produce that here locally in the United States. And if we were smart, we would open up the XL pipeline and get our crude oil going again and decrease all the gas prices at the pump as well, and also decrease everything that's made with crude oil. PVC pipe, building materials, paint materials, sealers, all that stuff is made with crude oils. And we could reduce that by opening up the XL pipeline and putting people back to work, and which hence would even stimulate us economically, because there's going to be a need for housing in those markets. So, ladies and gentlemen, Feds increased the interest rates by 0.25% today, 1 basis point, and we're going to expect more of this to come throughout the year. Now, just remember that if you go back pre-pandemic, 2 years ago, 3 years ago, by 2018, this is the first increase that the Feds have done since 2018, and really, in all honesty, the interest rates are still in a really good place. We're just going to start seeing the market reverse a little bit to a couple of years ago, which we were still living through an incredible economy 2 years ago, pre-pandemic. And we're going to continue moving and migrating in that direction. With everything that's happening economically, I can sit here and rest assured that the Feds are leading us in a direction where I don't know if they have our best interest in mind. I think they have their best interest in mind, the Federal Reserve. But I think that if we follow suit and we watch what the big institutional buyers are doing, and we follow what the big institutional buyers are doing, like BlackRock, Greystone, and these big institutional REITs, there's a great indication of market trends that you should watch. When those guys retract and pull back, guess what you should do? Pull back and retract. Reevaluate your investment method, and then after you reevaluate your investment method, go back in and start assessing a new business model, because the investment method doesn't end. There's still investment opportunity. Just the way you do it and how you invest and what you invest in may change. So, ladies and gentlemen, let's see. I'll answer a couple questions here. Look to build my first house in Oklahoma this year. Do you think material prices will go down at all this year? Houses are selling around $175 a square foot. Now, will that increase this year? So if you guys work with me, you guys know my business model. I won't even build in an area that doesn't support at least $210 a square foot or better. Okay. First and foremost, building costs are too expensive. And so all I would tell you, Corey, is go into a more affluent area. I promise, if you're in Oklahoma, there's money in Oklahoma. There's a ton of money in Oklahoma. There's a ton of agricultural money in Oklahoma. There's good economic growth in Oklahoma. You're just building in the wrong area. I'd be afraid to build in an area that only supports $175 per square foot, because that area, Corey, is less affluent. And whether that fits your business model, I'd rather go bigger and into a more affluent area where I have an ROI, a return on my investment, as opposed to that area. Because with building prices the way they are, they're not going to go down this year. We're not going to see it. We may see a little relief on lumber, hopefully, God willing, where maybe we can get some stuff stabilized coming in from the Canadian border. But we're now for the first time looking at doing some bigger trade with Germany, and for construction materials here in the United States, now that everything that's happening in the Ukraine. And so if we start seeing open trade from Germany and some of those markets, if we're smart enough to open those doors, we're going to start seeing a relief of that, hopefully by the end of this year. Now, are they going to be substantial? Probably not. But I will tell you that that don't expect it. Just know that where the prices are now, we're going to see a little increase in values, not as much as we saw last year. We're going to take it a little bit in the pocketbooks based on the information I just gave you. Us as builders will take it a little bit in the pocketbooks, but don't feel sorry for us, because I'll tell you, pre-pandemic, we were averaging on about a $600,000 house that we built. We were averaging about $130,000 in profitability on that house. If we built it right, like if you built it under my business model, that's what we were profiting. The average builder was probably making between 60 and 80,000 on that same exact house, because most of them don't have the business sense to do it in the magnitude that we do it in. And that's why what we do works so well is we have a specific business model that we do. And I don't fluctuate from that, because I'm greedy. I want my time. I want my ROI to be substantial. I'm going to go after the largest return on investment that I can get out of any market sector. So my business model, I'm greedy in that business model. I won't even fluctuate from it. That's why I tell Corey, don't build in that $175 per square foot one. You need to go find comps that are over $200 a square foot. And the higher over 200 you can get, the better. Because construction materials are going to cost you the same whether you build in $175 per square foot neighborhood, or you go and build in a $225 per square foot neighborhood. Construction costs are the same in both neighborhoods. You just have a better appraisal in the one that it has better affluency. And you can build the same damn house. If you're going to build a 2,400 square foot house there, go build it in the other neighborhood. You might pay and spend $20,000 more for the land, but you're going to probably land up having a value. Well, let's see, $2,500 per square foot. If you're at $225 a square foot versus $175 a square foot, that's a $50 per square foot difference times 2,500 square feet. That's $125,000 of additional value on that exact same home. The exact same home is worth $125,000 more in that neighborhood. So who cares if you pay $25,000 more for your lot? You have $100,000 of additional equity in that house, building in a more affluent neighborhood. Don't be afraid to move up, ladies and gentlemen. That's the biggest problem with people, is they're afraid to move up. They feel like they're non-deserving. Don't build in that $175 per square foot neighborhood, Corey. Go sell that land, shit can it, and go build in a more affluent neighborhood. I'm telling you, you could thank me later. Don't build in that neighborhood. Go build in a more affluent neighborhood that's nicer. You may say, I don't fit in that neighborhood. Who cares? Go build in it. You do belong in that neighborhood. Go build in whatever neighborhood is going to give you the most affluency and the best return on investment. Okay, come in and work with us in our inner circle, Corey. I'll show you exactly how to exercise that business model. People will sit back, builders that have been building for 40 years, they'll sit back and go, this guy's full of shit. He can't do it. I'll say, to my point exactly, you've been building the wrong shit for 40 years and you're broke doing it. And there's a lot of them out there. A lot of blue collar guys don't know nothing about business that are barely making a nut over what they're building for. And hence, hire them to build your house, and then you make the return on investment. Okay, they might be a badass builder, but they don't know shit about business. Okay, so I'll teach you both ends of it. One other question: how do you get into the subdivisions that other builders have locked down on? You can't. If they're locked down on it, you can't get into those subdivisions. But I believe you me, there's other subdivisions out there. There's other developers, land developers like myself out here. I'll tell you, my son and I were in Denver, in Denver, Colorado. We drove into Boulder. Okay, we spent the night in Boulder, and we were driving to Littleton. And I was there for all of about 24 hours. Okay, this is how easy it is to find land, Corey. And this is how easy it is for all of you guys to find land. Look. We drove into Boulder, and we drive out to, we fly into Denver, drive out to Boulder, and there's this little country road as we're driving into Littleton, Colorado, coming in from Boulder, right in downtown Boulder. And we drive up this little country road going to Littleton. And I can't remember the name of the highway. I wish I did. For those of you guys who are in Denver, you guys can go down there and drive it. If you just Google Littleton, Colorado from Boulder, it'll take you down this little country road. And as you're going, there's a subdivision that opens up, one on the left, one on the right. And it says lots, custom lots for sale. And there's a ton of badass homes in there that are going out, or they're being built. And it said starting at the low 600s. That's the subdivision you need to be building in, because they're selling lots to end buyers, right? When you go out with your wife to look for your dream house and your dream subdivision to build your own custom home in, you don't have to hire that builder. Most people don't. They'll do like an owner build, or they'll hire an independent builder. Where do you think these independent builders are buying that land? in the same subdivisions I'm telling you guys to go out and buy your land in. Don't go after the program builders, the tract builders that have a lockdown on your land. I just sold a 40-acre subdivision to a builder that we developed. I wanted to keep 4 lots, and they told me, no go, Jerome, you can't keep them. If you go keep 4 lots, deal's done. It's over. So guess what I did? I sold them the whole damn subdivision. They cut me a check. I just wiped my hands and said, cool, I'll go find 4 lots somewhere else. I wanted to keep 4 lots, but it didn't work out that way. So that's how you find them. But if we teach all that in our inner circle, by the way. So you guys can click below. I think one of the team members just put that in the group chat, and it's the eliterealestatesociety.com. Anyways, ladies and gentlemen, interest rates are going up. We're going to see them 5 times this year. Don't panic. Just invest wisely. Keep following our content. Click below. You like the content, pound that subscribe button and pound that thumbs up button. And we'll see you next week on Real Talk on Real Estate. And I'll keep informing you guys as to how interest rates, the Feds, the war on Ukraine and Russia are affecting our market and are affecting us economically. And for more content like this, I'm going to put another video up here. If you guys want to see more information about how this affects you financially, click on the video, wherever it is, down below, side, up or down. Click on it. We have a lot of them on interest rates, banking, mortgages, and how money is being utilized right now to invest during uncertain times. I look forward to seeing you guys next week. Thank you guys for joining us for our Real Talk on Real Estate. God bless you guys, and go out and compound your success.